Okay, so you want to buy a self-storage facility. You buy a rectangle of land, cover it with rows of metal doors, install a gate and some cameras, and rent hundreds of empty rooms to people who apparently own more things than their homes can hold. No kitchens, no bathrooms, no furniture. No guests calling the front desk because the air conditioner is too loud. A storage facility can be almost full and still be a bad business. The customer brings the boxes, carries the boxes, locks the door, and often does not come back for months. You keep charging them anyway. It sounds like the closest thing in real estate to free money, and the margins appear to prove it. Public Storage reported a same-store net operating income margin of 78.4% for 2025. That means after the direct cost of operating stabilized properties, most of the revenue was still standing. A hotel would love that number. A restaurant would frame it and hang it above the kitchen. A landlord with apartments would ask why your tenants do not need plumbing. Here's the problem. A storage facility can be more than 90% occupied and still disappoint its owner. A brand new building can open with 500 clean units and lose money for years. The customer who moves in today may pay almost 40% less than the customer behind the identical door next to them. And a competitor that is not opened yet can destroy the assumptions you use to justify the purchase. Because you are not really renting empty rooms, you are managing two prices: a local supply problem, a Google advertising auction, and the customer's growing reluctance to move everything again. By the end of this video, you will know what a small, medium, and large storage facility can cost, where the money actually comes from, why the first advertised rent is often not the real rent, how a beautiful new property can still lose more than $200,000 a year, and why the biggest companies in this industry are paying billions for pricing systems and customer relationships disguised as rows of doors. Before you buy one, you need to decide which version of the business you are buying. The first version is the small drive-up property. Think single-story rows, outdoor access, a basic office, a gate, cameras, and enough land for customers to pull a truck directly in front of the unit. A property with roughly 25,000 rentable square feet is not tiny, but it is still small enough to feel like one local business rather than an institutional platform. Using Public Storage's 2025 acquisition and development activity as a rough portfolio-level reference, finished storage space was changing hands or being delivered at roughly $140 to $146 per rentable square foot. At that benchmark, 25,000 square feet represents around $3.5 to $3.7 million before the exact financing structure, closing costs, renovations, working capital, and local differences. When construction ends, you may own a finished building full of very expensive air. The second version is the serious suburban facility. Around 50,000 rentable square feet, hundreds of units, a mixture of small and large spaces, perhaps climate control, elevators, covered loading, outdoor parking, or a converted warehouse. At the same rough benchmark, you are now around $7 to $7.3 million. The third version is the urban multi-story building. Around 100,000 rentable square feet, expensive land, elevators, fire systems, climate control, interior corridors, loading zones, traffic problems, local permitting, and a construction schedule that can continue long after your spreadsheet said the building would open. At the same benchmark, the rentable space alone points toward $14 to $14.6 million. In a difficult urban market, the real number can be much higher. The scale also changes the job you are buying for yourself. At the small property, you may know the customers, handle delinquency, call the gate contractor, answer reviews, inspect units, and decide the price manually. At the medium property, you need a real operating system, software, marketing, maintenance vendors, rate controls, and somebody responsible when the manager is sick. At the urban property, the elevator, climate system, fire code, loading access, and digital lead flow can matter more than the row of doors itself. The product still looks simple. The organization required to keep it full is not. And this is where the first trap appears. You can buy an existing property with customers already inside, or you can build one from scratch. Those are not the same decision. When you buy a stabilized facility, you are buying land, doors, online reviews, Google visibility, rental history, a customer list, existing rates, and some evidence that people in that neighborhood actually need the product. When you build from zero, you buy land, steel, concrete, cameras, software, and hope. Stopwatch buildings are generally not pre-leased. The day construction ends, the building may look complete from the street, while financially, it is almost empty. Congratulations! You own a very clean, very expensive building full of air. The rooms are finished. The business is not. Now imagine the purchase closes. You have the gate code. The property is yours. What exactly are you selling? At the simplest level, the formula is easy. Rentable square feet multiplied by occupancy multiplied by the rent you actually collect per occupied square foot. Then you add administrative fees, late fees, locks, boxes, parking, tenant protection products, and whatever other compliance services the property offers. Public Storage's stabilized portfolio averaged about 92% occupancy in 2025. Its realized annual rent was $22.54 per occupied square foot. Once the empty units were included, rental income per available square foot was $20.74. Apply that available space figure to a 50,000 square foot property, and you get a little over $1 million in annual rental income before other property revenue. The unit gets the customer through the gate. The monthly relationship creates the value. That sounds simple until you look at the doors. A 5x5 unit contains 25 square feet. A 10x10 contains 100. A 10x20 contains 200. They are not priced like slices of one perfectly uniform warehouse. The small unit often earns more per square foot because the customer is not buying square footage with laboratory precision. They are buying a complete, locked room that solves a problem. A 5x5 unit may hold boxes, documents, seasonal decorations, or the last objects left after a move. The customer pays for the solution, not for the geometry. So you are not only managing occupancy, you are managing unit mix. Too many large units, and the facility may struggle when fewer customers need that much space. Too many small units, and you lose the families, contractors, and businesses that need room for furniture, inventory, tools, or equipment. Climate-controlled units may command higher rent, but the elevators, HVAC systems, utilities, fire equipment, and repairs also follow you home on the income statement. Then come the secondary revenues. Public Storage generated about $129 million from late charges and administrative fees at stabilized properties in 2025. Its tenant reinsurance premiums reached about $251 million. Extra Space reported about $353 million of tenant reinsurance revenue and $129 million of management fees and other income. A small owner cannot automatically copy the insurance economics of a national REIT. Insurance and reinsurance are regulated. Program structures differ. Claims happen. But the lesson is important. The unit gets the customer through the gate. The monthly relationship produces the value. You are not selling an empty metal box once. You are selling the same unresolved decision again every 30 days. Now we reach the part that makes this business look less like ordinary real estate and more like airline pricing. You have two identical 10x10 units in the same hallway. Same size, same temperature, same distance from the elevator, same fluorescent light above the door. One customer moves in today. The other moved in 18 months ago. They may pay radically different rents. Public Storage's 2025 numbers show the gap. New tenants moved in at an average annual contract rate of $12.80 per square foot. The realized annual rent across occupied space was $22.54. Customers moving out had been paying an average contract rate of $20.30. Put that into one 100-square-foot unit. The new customer is around $107 a month before discounts. The average occupied unit at the realized rate is around $188 a month. Same door. About $81 more every month. Why would the new customer receive the better price? Because the empty unit earns nothing. The same 10 by 10 unit can rent for about $107 or $188. You would rather fill it at a discounted rate than allow a competitor across the road to take the customer. That is why storage websites show aggressive online prices and promotions, such as $1 for the first month. The cheap price gets the boxes inside. After that, the economics change. The customer has already rented a truck. They have carried the sofa, they have labeled 20 boxes, they have bought a lock, reorganized the garage, and pushed a difficult decision out of sight. To leave, they must do the entire job again. Another truck, another free Saturday. Another destination. Another argument about whether the old dining table is finally going to be sold, donated, or carried into a third building. That inconvenience gives you pricing power. Public Storage says it typically raises rents for long-term tenants every 6 to 12 months, often beginning after at least 5 months. More than half of its tenants had remained longer than 1 year at the end of 2025. But you cannot simply raise every customer forever. Push too slowly and you leave money on the table. Push too aggressively and the customer finally decides that moving is cheaper than staying. Then your $188 customer leaves and you replace them with a $107 customer, plus an introductory promotion and the advertising cost required to find them. This is the real machine. The empty door creates urgency. The move-in discount creates occupancy. Time creates inconvenience. Inconvenience creates the opportunity to raise the rent. And the entire business depends on knowing exactly how far you can push before the customer opens the door for the last time. This is the moment when the business starts to look irresistible. Your customer does nearly all of the physical work. They pack the goods, they drive the goods, they unload the goods, they arrange the goods, they remove the goods later. You provide a dry room, a lockable door, a gate, lighting, security, access, and a billing system. One employee or a remotely supported operating model can oversee hundreds of units. Customers can reserve online, sign digitally, receive a gate code, pay automatically, and sometimes move in without speaking to anyone at the property. That is how a stabilized facility can produce a property margin approaching 80%. But now look at where the money goes. At Public Storage's stabilized portfolio, property taxes were the largest direct operating expense in 2025 at about $378 million. On-site manager payroll was around $129 million. Marketing was $83 million. Repairs and maintenance were $78 million. Utilities were about $50 million. The building may need very few employees. The county still knows exactly what the land is worth. And net operating income is not the cash you take home. A high property margin can still disappear under the debt used to buy it. Your lender gets paid. The roof eventually needs work, asphalt cracks, gates break, cameras become obsolete, elevators fail, climate systems stop climate controlling, insurance increases. A storm can damage several buildings at once. A property tax reassessment can arrive without asking whether your rents increased at the same pace. Extra Space shows the difference at national scale. In 2025, it reported about $2.9 billion of property rental revenue. It also recorded $715 million of depreciation and amortization, $588 million of interest expense, and $186 million of general and administrative expense. A storage property can have beautiful property-level economics while the owner's capital structure is ugly. That is especially important when you financed the purchase at a high rate and used an optimistic occupancy assumption to make the deal work. The building does not care what your interest rate is. The gate opens at the same speed. The customer pays the same rent. The difference appears only after the debt payment leaves the account. So, yes, the operating margin can be extraordinary, but a high-margin property bought at the wrong price can still be a bad investment. You are not buying a margin percentage. You are buying the dollars left after the margin is forced to carry the purchase price. At this point, your property is open, the website is live, and occupancy is climbing. Then a sign appears 2 miles away. Coming soon, new climate-controlled storage. This is the part of the business that destroys people who rely on national averages. Self-storage demand is local. A facility may draw most of its customers from only a few miles around the property. Traffic patterns matter. Apartment density matters. Household income matters. Visibility matters. Reviews matter. The number of nearby homes matters. And then 500 new units can open at once. A new apartment project adds occupied units gradually as residents move in. A new storage facility can open hundreds of vacant doors on the same morning and immediately begin buying customers with discounts. Public Storage's national stabilized occupancy averaged about 92% in 2025. That sounds healthy. Now, look locally. Its Atlanta properties averaged 88.5% occupancy, while realized rent per available square foot fell 6.7% from the prior year. Dallas-Fort Worth averaged 89.5% occupancy and experienced a 4.1% decline in realized rent per available square foot. Honolulu was a different universe, 95.6% occupancy and more than $52 of realized annual rent per available square foot. Same company, same operating systems, same basic product, completely different business. Picture two owners who both bought a 50,000 square foot facility for the same price. One sits beside a fast-growing apartment corridor with limited new construction. The other sits in a suburb where 3 developers all used the same population growth report and reached the same conclusion at the same time. Owner 1 raises rates, spends less to fill vacancies, and watches the property value climb. Owner 2 offers discounts, watches customers shop every nearby website, and explains to the lender why the occupancy curve is 18 months behind schedule. The competitor that hurts you most may still be a construction site. Neither owner necessarily works harder. Neither building necessarily looks better. The difference was decided by supply inside a small circle on the map. That is why a national statistic cannot rescue a bad site. The next problem is how customers find you. More than half of Public Storage's new customers in 2025 came directly or indirectly through Google search. So your quiet real estate business is also participating in a digital auction every day. The customer types "storage near me." You bid against every nearby operator for the click. When the market is undersupplied, you may not need to pay much or discount heavily. When several new properties open, everyone lowers introductory rates and spends more to fill the next empty door. Now the competitor hurts you twice. They reduce the rent you can charge, and they increase the cost of finding the person willing to pay it. This is why the most dangerous storage facility in your market may be the one that currently has no customers, no reviews, and no revenue. It is still under construction. It has not started discounting yet. Maybe you are not worried. You have seen the television shows. A tenant stops paying, you open the unit, and suddenly there is a vintage motorcycle, a safe full of cash, and a bidder willing to pay $5,000 for a pile of boxes they cannot inspect properly. Storage auctions look like a second revenue stream. They are not. The business works when the tenant pays. A delinquent unit is a customer who stopped producing rent while still occupying inventory you cannot immediately sell to someone else. Lien rules vary by state. In Texas, for example, the facility receives a lien on stored property for unpaid rent and related charges, but the operator must follow statutory notice and sale procedures. The property does not become yours the morning after one missed payment. You send notices. You wait. You document. You advertise the sale. You follow the contract and state law. Then, somebody buys the contents, perhaps for less than the unpaid balance and less than the cost of the entire process. If the unit contains personal records, photographs, vehicles, hazardous material, firearms, or property subject to another lien, the simple television version becomes even less simple. A storage auction is not a treasure hunt for the owner. It is a collections process with folding chairs. And delinquency is only one operational problem. Auto-pay is the business model. The auction is the collections process. Theft can damage customer trust. A broken gate can create access problems. Water intrusion can produce claims. Fire can move through multiple units. A climate-controlled building can lose the system that justified its premium rent. An elevator failure can make upper floors almost impossible to lease. A customer can drive a moving truck into the building. A storm can damage roofs across an entire local portfolio. Then there is insurance. Tenant protection products can generate attractive revenue, but the risk does not disappear because the premium was charged automatically. Claims rise after thefts, fires, floods, and severe weather. The structure may involve third-party insurers, licensed entities, or reinsurance programs that a small operator cannot simply invent at the front desk. Healthy self-storage economics are boring. Thousands of customers pay automatically. The gate works. The roof stays dry. Nobody discovers a motorcycle. Auto-pay is the business model. The auction is what happens when the business model fails in one unit. Now, let us look at what this becomes at scale. Public storage ended 2025 with 3,171 facilities and 229.4 million rentable square feet. Extra Space operated 4,281 stores, including owned, joint venture, and managed properties. It managed 1,856 stores for third-party owners. At that size, the company is not simply a landlord with many addresses. It has a national website, call centers, pricing software, customer data, insurance programs, management contracts, acquisition teams, debt access, and the ability to compare one market with thousands of others. A small owner knows the neighborhood. A national operator knows what happened to move-in prices in every neighborhood last week. That information changes the business. The large operator can lower the web price on one unit size, raise existing tenant rents in another, move advertising budget between markets, centralize customer service, and manage facilities for owners who cannot afford to build the same system themselves. The property becomes one node inside a pricing platform. And that platform can see something the local owner often cannot. It can compare how a 5x5 unit behaves against a 10x10 unit, how customers respond to a $10 increase, how long a discount takes to recover, and which online search terms are producing tenants who stay rather than tenants who leave after the promotion ends. At one property, that may look like a small pricing decision. Across several thousand properties, a small improvement applied repeatedly can be worth hundreds of millions of dollars. This also explains why consolidation deals become so large. In March 2026, Public Storage agreed to acquire National Storage Affiliates in an all-stock transaction valued at approximately $10.5 billion. NSA brought more than 1,000 properties and roughly 69 million rentable square feet. As of July 10, 2026, the company said they expected the transaction to close on or about July 22, subject to shareholder approval and other closing conditions. Public Storage is not paying $10.5 billion because metal doors suddenly became more interesting. The largest operators are buying pricing systems and customer data disguised as buildings. It is buying customers, locations, local market share, operating data, management income, tenant protection economics, and the ability to move another 1,000 properties onto one platform. Extra Space tells a similar story from another angle. In 2025, it generated about $353 million of tenant reinsurance revenue and $129 million of management fees and other income, in addition to property rent. The biggest storage companies have several ways to earn from a unit, even when they do not own 100% of the real estate behind it. They can own the property. They can manage the property. They can participate through a joint venture. They can provide bridge loans. They can earn tenant protection income. They can acquire a weaker property, improve pricing and occupancy, and increase the value of the real estate. That is the final form of the business. The local operator rents rooms. The national operator rents rooms, sells management, prices customer behavior, earns insurance-related income, and buys the data produced by every move-in and move-out. The doors are still the visible product. The system behind the doors is what scales. All right, let us finally calculate what you might make. Same property in both scenarios. 50,000 rentable square feet, total purchase or project cost, $7.5 million. You put down 40% or $3 million and finance the remaining $4.5 million at an illustrative 7.25% interest rate amortized over 25 years. Annual debt service is roughly $390,000. Scenario 1 is the property you imagined when you decided this business was easy. The facility is stabilized at 90% occupancy. Average realized annual rent is $20 per occupied square foot. Rental revenue, $900,000. Administrative charges, late fees, parking, merchandise, and other property income add $35,000. A compliant tenant protection arrangement contributes another $25,000 of net property-level income. Total revenue, approximately $960,000. Operating expenses are $310,000. Property tax, payroll or remote management, utilities, insurance, marketing, repairs, software, security, and normal administration. Net operating income, about $650,000. Now pay the lender $390,000. You have around $260,000 remaining before income tax, owner-level overhead, major capital replacements, and reserves. That is a good property. It is also a $7.5 million property that required $3 million of your equity to produce that result. One roof project, tax reassessment, elevator replacement, insurance problem, or refinancing shock can change the year quickly. Now, scenario 2. Same doors, same cameras, same gate, same debt. But two competing facilities opened nearby during construction. Your occupancy reaches only 65%. To attract customers, your realized annual rent is $14 per occupied square foot. Rental revenue, $455,000. Other income adds $20,000. Total revenue, $475,000. The facility is less occupied, but the property tax did not fall 35%. The gate still exists. The cameras still record. Insurance still renews. Software still bills you. Basic staffing and maintenance still happen. Operating expenses, $300,000. Net operating income, $175,000. Debt service, $390,000. You lose about $215,000 before taxes, owner overhead, and major capital work. Hundreds of customers are paying you every month. The building may look busy, and you are still writing checks to keep it alive. So you lower the web price to fill more units. The competitor lowers theirs. You spend more on Google. They offer 2 months free. You raise one group of existing tenants and some of them leave. You delay maintenance and reviews fall. You cut advertising and move in slow. The first property is a recurring revenue machine. The second is the same physical product with the wrong local supply, pricing, and capital structure. The difference between them is not the quality of the roll-up door. It is everything the customer cannot see. So, should you buy a self-storage facility? The good version of this business is genuinely attractive. Revenue repeats every month. No single customer controls the property. Labor can be limited. A stabilized facility can produce exceptional property-level margins. Customers often stay longer than they originally planned, and once the boxes are inside, the inconvenience of leaving can protect your pricing power. But none of those strengths guarantees that your deal works. The building does not create the customers. The national occupancy rate does not pay your local mortgage. A full facility can still be underpriced. A nearly full facility can lose revenue when new customer discounts become too aggressive. A high NOI margin can disappear under debt service. And one new competitor can force you to lower prices while paying more to advertise them. The weakest operator builds rooms and waits. The stronger operator manages occupancy and rates. The most powerful operator owns a platform that knows what every room, every customer, every market, and every move-out is worth. So if you ever evaluate one of these properties, do not begin with the number of doors. Ask what new tenants pay. Ask what long-term tenants pay. Ask how often rents increase and how many customers leave afterward. Ask how many facilities are under construction within a few miles. Ask what it costs to win the next customer online. And ask how long your cash can survive if the building takes 3 years longer to fill than the spreadsheet promised. Because self-storage is not really a business that stores people's possessions. It is a business that stores postponed decisions. The room holds the boxes. The delay pays the rent.